Right now, something interesting is happening in the world of investing. Quietly, and without the noise you might expect, smart investors are making moves behind the scenes. They're not panicking, they're not chasing hype, but they are adjusting. And the reason is simple: the market environment is changing. If you've been paying attention, you'll notice that stocks, bonds, and even alternative assets are behaving differently than they did just a year ago. This shift is exactly why portfolio rebalancing is becoming a major focus again. So what does rebalancing actually mean? At its core, it's the process of adjusting your investments to bring them back in line with your original strategy. Over time, some assets grow faster than others. For example, if stocks perform well, they may start to take up a larger percentage of your portfolio than you intended. That might sound like a good thing, but it also increases your risk. Rebalancing is how disciplined investors maintain control. Rather than letting the market dictate their exposure. Now, here's where it gets important. Over the past year, we've seen a mix of high interest rates, persistent inflation concerns, and global economic uncertainty. These factors have created uneven performance across asset classes. Some sectors, like technology, have surged at times, while others, like bonds, have struggled and then started recovering. This kind of environment naturally throws portfolios out of balance. And when that happens, smart investors don't ignore it, they act. One of the biggest reasons investors are rebalancing right now is risk management. When markets rise quickly, it's easy to become overexposed to the best performing assets, but history shows that what goes up fast doesn't always stay up. By trimming positions that have grown too large and reallocating into underweighted areas, investors reduce the chance of major losses if the market suddenly shifts. It's not about predicting the future. It's about preparing for it. Another key reason is opportunity. Rebalancing isn't just defensive, it can also be strategic. When you sell assets that have performed well and buy those that have lagged, you're essentially following a buy low, sell high discipline. This goes against human instinct, which often pushes people to chase winners and avoid losers, but experienced investors know that undervalued areas can offer strong future returns, especially when market conditions change. Interest rates are also playing a huge role in today's rebalancing decisions. For years, low rates made stocks the most attractive option. But now, with higher yields available in bonds and fixed income assets, the equation has shifted. Investors who previously ignored bonds are now reconsidering them as a source of stable income and diversification. This change alone is causing many portfolios to be adjusted in ways we haven't seen in a long time.